actually this coincides with the launch of our 2026 Outlook, which we've called Promise and Pressure, because it speaks so much to what we see lying ahead of us. I mean, the market at the moment is obviously feeling the pressure, and it feels uncomfortable because we haven't had any meaningful drawdown really since the spring. But, a lot of the conversations we're having with clients is that, a small correction, of which I define as anything from 5 to 8%, is not unhealthy. And actually, we think it would pave the way to 2026 being actually quite a strong year. So our expectations are that, driven by corporate earnings growth of around 11%, you could see the S&P deliver double-digit returns in 2026. So that takes you to around 7,300. And that is, it's a bold call insofar as that would be a fourth year of double-digit equity market returns, which we haven't seen for over 30 years.
And the equity market rally has not really broadened out. Are AI stock valuations and investment at this pace in CapEx sustainable? Yeah,
so I would say the answer to that broadly is yes, but I would focus on the sort of the broadening out theme as being one of the key facets of our outlook. This year we've had technology and financials as two key sectors, and for next year we're also adding industrials, utilities and healthcare as well, which speaks, Caroline, to that broadening out theme. Now, some of this is related to digital transformation, because we're not just talking about hyperscalers and AI, where obviously hyperscalers have been the main beneficiaries of the AI build out so far, and we think that can continue. Earnings growth from that group will continue, at least for the next 12 months, I think, to be significantly ahead of the market. But we must also think about the power needs, of which utilities come in, and further infrastructure needs where industrials come in. And so I think all of these sectors should be contributing to that 11% earnings growth that I mentioned for next year.
In the sort of the broader scheme of how pieces get put together now that we're catching up on the missing data, for example, out of the US as well, is there a chance that the outlook gets significantly altered by the end of the year when we think about where the Fed is going to go?
I mean, there's always a chance, but our sense is that the labour market is cooling but finding its footing. So we don't expect it to weaken significantly more in the months ahead, or the upcoming data to indicate that is the case. When it comes to then the growth outlook, I think growth has been held back by uncertainty, whether that be government shutdown related, trade. I mean, there's any numbers of things that we could cite that have led to uncertainty, and we're seeing those in the consumer confidence data. So we actually expect growth to improve in the first half of next year as some of the stimulus comes through, direct to consumers in some case, and more just broader fiscal spending in the case of others. And therefore, that's probably going to reignite some inflation fears. The market feels pretty benign when it comes to inflation at the moment. Obviously, the inflation data has continued to edge lower, but stronger growth, warmer inflation means it's probably right that the Fed won't be trimming quite as much as the market expected. And I think that's part of the indigestion that's going on at the moment, that the market's coming to that conclusion.
Okay. What about UK CPI that is also coming out this week, right ahead of the Chancellor's budget, just after the meltdown and gilts on Friday? What does it mean for the next Bank of England decision? How much of a risk is budget day?
Yes, I mean, I think it is going to be quite a significant event risk. The UK economy does definitely have, the sense that it's weakening, the labour market's weakening quite considerably, and that could force the Bank of England to cut into a situation where fiscal risks are obviously front and centre. And so, the UK as a region, we do have positions, particularly in the gilt market, but from an equity perspective, we do think that there are other areas of greater interest where you've got a more optimistic backdrop. And I would point really to continental Europe and some of the European defence names. Obviously, UK has got some defence names that can do well, but I think the broader themes favour regions outside of the UK when it comes to equity market returns.
On the question of the AI, I suppose, picture from here on as well, of course, we're thinking about in the short term NVIDIA earnings as well. But on this question of bubble risks and when we start to see some change perhaps in the approach to AI investment too, do you see that as a broadening theme? Are we still going to be talking about the hyperscalers in a year's time when it comes to the main drivers of this?
I think we will be talking about the hyperscalers. But I think, look, the AI so far, specifically with the hyperscalers, they've been driving this huge CapEx. And when I say huge CapEx, obviously it's been upgraded significantly through the course of this year, and that's been supported by earnings growth. But still, leverage from this group is pretty low, below half a turn of leverage. And so I think that you're going to see more leverage come into the space to support, these huge numbers. But I think the hyperscalers are still in a good position to benefit from that. I mentioned before other elements, the power build out, I think, is going to be really important. And as we're also getting to adoption rates, depending on the measure that you're looking, but across the US economy, adoption of AI is anything from 10 to 40%. You should now also be starting to see some of the companies being able to better differentiate themselves, not just on whether they're using AI to improve operational efficiency, which could obviously support margins, but more importantly, and what I think the market will be more interested in, is whether they can articulate AI as a revenue driver that can compound positive market share gains. So that will be the sort of the third leg, so to speak, of AI. And then I also think, let's not underestimate the role of private markets. The largest 10 private tech companies are now worth $1.5 trillion. And often when it comes to investing globally, Europe is overlooked as, there isn't the technology exposure when it comes to Europe. And that's true in public markets, but it's not true in private markets. And a huge number, 96% of European companies with over $100 million of revenue are actually privately listed. So this is a great way for clients to get diversification by geography whilst tapping into some of these themes in perhaps a less appreciated way.
I thought it was interesting that with gold up more than 50% year to date, you've got a very bullish price target again, $5,300. How quickly do you think we'll get to that sort of heady level, and why?
Yes. So no, we're being bold when it comes to gold, as we were in 2025. We're doing it again in 2026. And because many of the drivers we still think remain in play, in the Outlook, we explore three key themes: artificial intelligence, global fragmentation, and inflation. And gold, fits two out of those three, the latter two, fragmentation and inflation risks to some extent. Buying of EM central banks, I think, is still going to be a key driver. That's been a theme over the last couple of years, linked to geopolitical threats. But, when we look across EM central banks, there's still a good group of them that have got below 10% holding of gold. China's now up to about 9%. But if you look at European central banks as some sort of benchmark, they're at around 15% plus. So I still think more buying from EM central banks linked to geopolitical issues, and ditto for large institutional investors and also retail money as well. And we can see that in the ETF buying.